Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
M&A Unplugged community, have you ever wondered what type of legal review is necessary as you contemplate the potential sale of your business? The reality is the legal checklist can be rather extensive, but there are lots of opportunities, if properly planned, to improve the business value and ease of succession. Today we have an outstanding attorney, Dave Buckley of Kelleher Buckley, to discuss a few of the legal areas to consider prior to sale. For business buyers in the audience, this will also inform you of the right questions to ask a seller prior to consummating a transaction. Dave co-founded Kelleher Buckley with Andy Kelleher in 1997. Dave concentrates his practice on corporate transactions and succession planning for business owners. Dave is also a CPA, so he possesses a unique understanding of his clients' personal and financial needs. Dave, it's such a pleasure to have you here today. Welcome.
Thank you very much.
So, Dave, let's start with, if you wouldn't mind, giving the M&A Unplugged community a quick backgrounder on yourself and on the firm.
Sure. So, went to Miami of Ohio, undergraduate with degrees in accounting and finance, worked in Northbrook, Illinois for about a 25-person CPA firm, went to Loyola University, Chicago Law School at night, and after graduation there, worked at Schiff, Harden & Waite in Chicago for 3 years, splitting my time between the corporate group and the estate planning group. And then Andy and I formed Kelleher & Buckley, as you indicated, in 1997 and have been doing that ever since.
Well, you guys have really built a hell of a firm. I mean, the time that I've known your firm, the growth there has been amazing.
Yeah, we've been really fortunate. Most of the attorneys who do the sort of work we do are located in the Loop in Chicago. So there's a real need in suburban Chicago for firms that can do, both high-level work, but also with suburban accessibility and be able to do that high-level work in different areas. So we've been really fortunate that we located out here where there's a real need for our services.
And you've attracted some great talent along the way, too.
We've merged in a couple of really experienced practitioners in practice areas that Andy and I don't personally focus in, mainly being litigation areas, and bringing on some really good corporate talent with people who've been at firms like Baker and McKenzie, Schiff, Harden & Waite like myself, Arthur Anderson. So we've really been able to attract a great team.
Yeah, congratulations on that growth and success. And I interviewed Andy in a previous podcast, and I've gotten to know your firm a bit. We've done some transactions together, and you guys do tremendous work. You're really a top tier firm.
Oh, thank you. That's what we strive to be.
So you mentioned, and I think I mentioned in my intro, you're both a CPA and an attorney. And boy, it sounds like you did a lot of schooling in a short period of time. But I imagine that having both your legal background and being a CPA really benefits your clients. How do you leverage that on a day in, day out basis?
Yeah, both Andy and I and a couple of our other attorneys have our CPA designation in addition to being attorneys. And it's really helpful because that, along with having actually practiced in public accounting, we're able to see things from the perspective of a lawyer, and a lawyer who does estate planning along with corporate representation, but also able to put our CPA hat on, both from the perspective of the tax issues, but also the practical issues that you deal with clients as a CPA. And then with Andy and I founding this and building it, we're also business owners. So we started at the ground up with the two of us and now have about 55 people. And so I think the combination of the perspectives of having the law firm hat, the CPA firm hat, and the business owner hat enables us to relate to our clients and deal with them better because we understand better where they're coming from than somebody that just has one of those three hats.
Yeah, yeah, boy, they're getting a lot of bang for the buck at the end of the day. They're getting a number of different professional perspectives. I got to believe that that really benefits your clients.
It does, and I think the estate planning is a critical part of that because the mindset when we're drafting somebody's estate plan is we're going to be sitting with the widow or the kids 10, 20 years down the road, and this has to work. So we're not just drafting the documents, we're going to administer them and help the family years in the future. In that sort of long-term perspective, what does it look like in that 10 or 20-year period is really helpful for the business owners because the business owners are they're stuck in the tyranny of the everyday, right? They're trying to get their orders out, they're trying to get new things, and being able to, deal with them and coach them and get them to slow down and think about that long-term time horizon is helpful because they oftentimes don't have the natural energy or focus on that because they're trying to solve the problems of today and this week, not 2 or 5 years down the road.
Yeah, and probably there's a psychological component to that as well. I would imagine that most people really don't want to think about that phase, right? They want to remain vital and relevant and thinking about planning for those sorts of stages in life. I imagine it's a hard thing for people to get their heads wrapped around.
It is because for most of our clients, most of them founded their companies, or if a previous generation did, it's still part of their family identity. So getting them to think about it in a way where they're not as critical to the operations can be a real challenge because in their mind, that's who they are.
Yeah, yeah. They associate themselves with their business so often, right? So bringing it over to, M&A and the preparation of a business from a legal perspective, let's spend some time talking about, maybe we can keep it at a high level and then we can drill down from there. But when a client, comes to you and first says, I'm thinking about potentially going down the path of a merger or an acquisition or a succession plan, what sorts of legal documents are you focused on, or legal areas are you focused on with that client to help them prepare?
Well, the first part before we dive into that is usually so let's assume that you got everything that you wanted. Tell me what that looks like. For you as the business owner, is that a certain amount of money? Is that the business continuing with protecting your current employees? What does that really look like? Because for a lot of business owners, it comes down to I'm not sure how long I want to do this anymore, because it's very difficult to operate a business. So we want to first have an understanding of, okay, this is going to work exactly the way you wanted. Tell me what that looks like. Tell me what that looks like for you personally after that. And then once we have an understanding kind of on the seller side, then we'll usually talk with them about the buyer side. And I typically relate selling your business to like staging your home for sale. It's like, so imagine you're going out to buy a house. You drive up to the house. What does the curb appeal look like? What does the inside of the house look like? Does it meet your needs? That's exactly what buyers of businesses are doing. And so we have to get the business owner to think, you're not the seller here. What if you were the buyer? What are the things you would be looking for that would make you want to invest this sort of money in something new? And let's make sure we provide those things to the buyer well before we have a clue who that buyer is. Because whether the buyer is going to be an internal succession plan with key management team or the next generation, whether it's external with an industry person or with private equity, everybody's looking for the same stuff. And so we try to get the seller mindset to be pretend you were the buyer of this company. What is it that you're going to see about it that's going to make you not pay full value for it? And how do we change that?
Yeah, that's great advice. It's starting with the end in mind is so critical, as you mentioned, and then envisioning what a buyer wants so that you can maximize the value of your asset, which is typically their largest asset, is so critical. So once you go through those steps with somebody and they can think through that, where do you then take the process or the conversation from there?
So, what we'd usually say as the next first step is let's look at who your current team of people are and let's get that team together so that we're all having one discussion about what you want to do. Because while we're going to have a good perspective from the legal side, the CPA is going to have a different perspective. And if things are working well, they're talking to their CPA more than they are to us. And if they're working with a firm like yours, you're going to have a different perspective because you know what the market currently is and what the process is like. So we usually want to assemble the team for a meeting, even if it's 3 or 4 years in advance, and say, okay, let's draw out that picture for when you're ready to sell. And let's all agree on the sort of things that we should be working toward to stage that house perfectly as we talked about.
Yeah, and preferably it is years in advance, right? What we find is the folks that come to us a couple of years before they're ready, they put themselves in the best position for that moment in time. And that moment in time may come at your choosing or not at your choosing if there are other outside events that affect that, right? So being ready at any moment is so critical.
Yeah, absolutely. And with a lot of our business owner clients, if you're the business owner and you are used to being in charge and you sell your company and now somebody else is in charge, you're not typically going to be as happy in that new environment. So we'll have buyers come in and say, "Oh, we want the seller to stay for 2 or 3 years because of their relationship with the customers and they know how it operates." And very often the seller either doesn't want to do that up front, they just know that, or they think they want to do it, but 6 months or a year in, they don't want to do that. So typically, one of the planning things is, do you have your internal team in place such that when the buyer comes along, you aren't going to be required to be there full time for this to work? So building the internal team and the internal structure and the processes you have is typically really important if you're going to be with a sophisticated buyer. The other benefit of doing that is if I've built that good team around me, I'm oftentimes willing as the business owner to keep the business longer because it's more fun.
Yeah, so true. So true. We see this time and time again. The more owners delegate, the more fun they have in their business as long as they've brought in the right people and they let those people do what they're good at, right?
Exactly. So we'll often say to business owners, okay, if you want to be done in 3 years, what if you were able to give away the 40% of your job you like the least and only keep that other 60%? What does 3 years become? And for some people, it's 3 years. But for most people, it's, oh, maybe five, maybe seven.
Yeah. Yeah, yeah. It's such a good point. Such a good point. So, Dave, let's talk a little bit about securing your internal team. I'm going to call them your key employees, your executive staff. So, the owner agrees with that strategy, and they're going to put those pieces in place. But there's a sale or merger or succession somewhere down the road. What sort of legal aspects are you helping that owner think through as it relates to those key people?
So, oftentimes for the key people, one of the main issues is how transparent are you going to be about your intention to transition out or to sell? And the better your relationship is with those people and the more transparent you're comfortable being, then the more likely it is that those key employees are going to be willing to stay through a transition and through any earnout period that's post transition. So we're typically trying to understand from our clients, well, who is the key team? What do they know? And when are you going to tell them? And oftentimes letting the business owner know just because you're not going to tell them doesn't mean they're not going to know. In other words, if they're a valuable part of your team, then they know how old you are. They have a general sense of your wishes and desires. So, what does that environment look like? Because we'd like to have written employment agreements with those key people. And we generally want to try to align their interest as the employee with yours as the business owner. So, I'm currently working on a succession plan with a business owner that anticipates selling probably in about 24 months. There's two really key employees there. So we're having them enter into employment contracts where they're going to participate on the upside of the sale above a current baseline. And we're going to time the payments that they receive after that change in control to line up with what we expect the seller to receive. So we're going to assume that most of the money is received at closing, but there's probably some earnout component, and that what those employees received is totally aligned with what the owner receives. And that owner has comfort that his team is going to be there post closing to maximize his earnout or upside after the transaction. The employees are grateful for that because they're on the inside and they know what's going on. They're also grateful because they know they're going to participate in value they create over the next 24 months and probably for the 24 months after that. And when a buyer comes in, they're going to see that the seller has, in a professional, diligent way, locked up the key employees with non competition, non solicitation, normal provisions, but has also treated his employees fairly and with a high degree of loyalty. And that makes a buyer way more comfortable.
Yeah, that makes perfect sense. Let me ask you, those discussions, I imagine they have to be carefully handled and are highly sensitive. So what do you typically advise owners to do there? Are they the first ones sitting down with those key employees and having the discussion, and then will they bring your firm in shortly thereafter? How does that unfold in the perfect scenario?
In the perfect scenario, we're having a discussion with the business owner and oftentimes with the CPA to talk through what the business owner's plans are so that prior to creating an expectation with the employees, they've got the advice of the CPA and us in terms of structuring it and what it's going to look like. Then typically the business owner is talking to the employee by themselves because it's a more natural discussion than the employee, being scheduled to go to the CPA's office and meet with the attorney, because that just is oftentimes a little less natural. So it's usually a discussion directly from the seller, but after they've had the advice and counsel of the CPA and attorney as to the general parameters.
And so what are the sticky issues that will come up in those discussions, and what and going to ensue will be somewhat of a negotiation, right, between those employees and the owner? What are the typical high level things that will come up?
So typically it's a positive conversation because the business owner is willing to agree in a binding contract to give the employee something they currently don't have any contractual right to get. So they're actually a lot less contentious than people would think because the employees are typically grateful. But the biggest issue is usually, can you fire me just because you want me to, just because you want to, or is there a standard? And if I do get fired, what are the restrictions on my ability to earn a living? Or what's your ability as the seller to terminate me right before a sale and not pay me?
Mm.
So those are typically the discussions we're having with the business owners so that when they talk to the employee, it is all couched as this is a positive thing. I'm willing to obligate myself to give you something you don't have a right to get today because you're really valuable to me.
And so this example that you just brought up a minute ago about you think the owner's maybe 18 to 24 months away from a potential sale. Is that about the right time frame to be doing that, or would you recommend doing it even much earlier than that?
I'd recommend doing it earlier because a lot of times what the business owner wants and their time frame changes. And so a lot of our business owners don't really know if they want to try to do an internal transaction, and they oftentimes haven't given the freedom to the other people to evaluate them fairly on whether they really could do it, or if they want to do an industry or a private equity. And as you know from what you do, selling to an industry person who really already understands what you do versus private equity are very different transactions. So we usually want to talk about it early because we want to have good financial statements from a reputable CPA firm, and we want those to be consistent over a several year period. Because if I'm the buyer, I'm paying you an amount of money to basically purchase the income stream that your business throws off. The more confidence I can have in that income stream and the more consistent it is, the more I'm willing to pay for it.
Yeah, yeah, absolutely. Do you ever see that these discussions wind up going in the direction of the key employees coming back to the owner and asking for an option on the business or a right of first refusal?
For sure. So, and we view that as a good thing because at least then you have people internally that are interested in doing what I call sitting in the big chair. And if they are interested, then you want to give them an opportunity to for you to evaluate if they are qualified to do that. Because the risk with an internal sale is typically you're going to get less money up front because your employees probably don't have the money to pay you 80 or 90% of the purchase price. So you're taking a little more of a leap of faith financially, but you're doing it with people you have worked with for a long time, which is good. But you typically want to first give them more authority and see how they do and try to mentor them, because what we see a lot more than I would have anticipated is everybody wants the big chair till they're in the big chair. And it
So
sounds
true.
great. I want to run the company and I want to have all the benefits you have, I see as the business owner. But when it comes time to sign on the dotted line with the bank, with a personal loan, and to go home and explain that to your spouse, oftentimes people chicken out.
Yeah, totally, totally different scenario. Wow, that is great advice before going down that path. Ratchet up the responsibilities and see if they really want to take them on.
Yeah, but the good part is let's assume they, as that key employee, they're given that opportunity and they decide, I don't really want to do the whole, I don't want to own the whole thing. It's much easier to go to that employee then and say, you are still really valued. Let's talk about that employment contract with the non-competition, the non-solicitation, where you can participate in the upside of a sale without ever having to sign that bank loan. It's a much easier discussion if the employee figures out on their own, I don't want to be the owner of this company, but I still want some of the benefits.
Yeah, yeah, yeah. Great advice. So, Dave, are there other aspects from a legal perspective as you assemble the team and start to talk to the owner that you look at and review with a client?
Yeah, so as part of what I called earlier the staging process, we'll typically go through with the client and the CPA. We have a master due diligence or legal audit checklist that says let's go through all this huge menu of issues and see which ones apply to you and which ones don't. And if there are things that apply to you that aren't where they should be for a buyer, at least you're now aware of them and can address them. So we'll see a lot of businesses that'll have not great diversity in their customer base, right? So it's not that they have 20 customers, each with 5% of the revenue. It's really one customer that's 40 or 50%. And oftentimes they may not have any sort of a contract with that customer. They've been just doing business forever. Well, that's obviously going to be a major buyer issue. And if the contact between the companies is business owner to business owner and they're both in their 60s, that will make that buyer really nervous. So we'll typically want to look at contracts with customers, contracts with key vendors and suppliers. We have a lot of clients that do a lot of business or source a lot of things in China where they may have products being manufactured over there, but there's really no written agreement. And as a buyer, you're going to be really nervous about that, and you're going to make much more of the purchase price contingent on future performance, and that puts way more risk on the seller.
Yeah, this is a great point. I mean, you referenced really pulling up a prospective due diligence checklist that the owner's going to get from a buyer anyway, and have them go through that checklist point by point. And as we know, folks, you and I know, go through enough transactions, usually half of the items on a due diligence checklist don't even apply, sometimes even more than that, right? But let's look at what's on this list that potentially applies, and understand, are there things you can do to improve the business and the ease of succession of that business.
Yeah, and another reason we like to start the discussions 4 or 5 years in advance is so that the seller can understand what the tax consequences of the sale are going to be. We recently had a transaction fall apart because a brand new client of ours who was the seller didn't get good CPA advice, and they were a C corporation, and inside of the C corporation was both the operating business and the real estate. And even though they got a buyer to offer the price they wanted, when they saw what the net amount was going to be after taxes to them, it just didn't work for them. And if we had been able to have a discussion with them 5 years ago, we would have been able to change that answer pretty dramatically.
Yeah, yeah, and you say 5 years because the window to convert from a C corp to an S corp or some other entity, so you don't have double taxation, is 5 years, right? The government has a 5 year look back. That's what you're referencing, right?
Correct. And they could also have, you know, spun out the real estate into a separate company under a holding company. So there's different techniques they could have done that they just didn't know about because they had grown up with the same CPA forever, and that CPA was in his late 60s and just, didn't really act proactively to protect the client.
Yeah, yeah. Yeah, this tax issue can really surprise a lot of people. We've had a number of C corp situations over the years of doing this, and in some cases there are some potential workarounds, but you have to be careful with those workarounds. And then, for example, I mean, I'll just list one. Personal goodwill we'll see sometimes utilized, but you have to be careful with personal goodwill. And then the natural thing is, an owner will ask, well, what will the buyer just buy the stock of the corporation? But, there are tax implications then on the other side to the buyer, and liabilities potentially that they need to think through.
Yeah, exactly. And there's some buyers that are willing to buy the stock, and there's others that just simply are not going to go there. And so part of going through the exercise of identifying who you think you're going to sell to, part of that is that'll help give us a better idea of whether a stock transaction might be possible or might not.
Yeah, yeah. I tell you, so often during my interviews here on M&A Unplugged, we come back to this key concept of preparation. I mean, it always boils down to, if you just take some time to prepare and assemble the right team, right? I mean, It goes beyond just maybe calling your local CPA that's always done your taxes. It's bringing in a firm like yours who has specific M&A experience, because the issues are going to be different than they are when you go to prepare your taxes.
Yeah, and I was talking with a business owner a couple months ago who was like, "Yeah, that sounds good, Dave. I'm not sure I really want to go through that exercise right now." And I said, "You just told me at the start of our meeting that you had your daughter preparing for the SAT for like a year and a half with different consultants. Why would you not go through that same process with the company you've built over 40 years?" Like you're doing it for other people, do it for yourself. It makes a big difference.
Well, and typically this is somebody's largest asset or top three assets, right? And I guarantee they're constantly looking at their portfolio of investments and modifying it wherever they need to. Your business is one of those and should be looked after with the same care and concern.
Yeah, and the other reason for the 5 years is really a non-legal one, which is you typically see if I own a business, I'm probably getting I'm going to say a roughly 20% return on my capital, right? So if I have a business earning $1 million a year and I can sell it for 5 times, I have 5 million of capital in that business in theory, and it's throwing off $1 million of income. Well, if I sell that business for 5 million, and let's say I owe $1 million of tax to keep it simple, now I have four left. Say I can invest that at 5%. Well, I've just turned $1 million of cash flow into 200,000. And in that process, I probably had a lot of expenses that were being paid for by the business that I now have to pay for personally. So if I sell the company and I'm done, I pay my own cell phone bill, my own car lease, probably some entertainment expenses that I'm going to pay personally. And it's good to walk business owners through that, because a lot of times we'll see business owners that you really can't afford to sell your business, right? Because you've got the entrepreneurial mindset that helped you build it and is why you're successful. But that's often the mindset that wants the vacation home and the jet skis more than a nice bond portfolio.
Right.
And so we'll say, if you really want to get out in 5 years, then you got to get with your financial planner and start putting your personal financial situation in order so that you'll have the freedom to decide to buy or sell when you want to. And a lot of business owners just haven't really thought about it that way, that the return on capital for a business is a multiple of what it is with passive investments.
Yeah. Yeah. I think the statistic is over 75% of owners don't properly prepare for an exit or succession of their business.
Yeah, that's definitely true.
Staggering, and when you
Yeah.
think about it, but true. Dave, this has been such a pleasure. What great information! But before we end the interview, I love, you guys do a lot of M&A transactions. You're really involved with business owners. Anything a high level from an M&A perspective, trends, or even advice that you'd offer up to the M&A Unplugged community?
Well, I'd hit on something we did earlier, which is get your external team in place. Make sure you've got your assets properly owned and allocated, separating business and real estate. Pay yourself in the leases and other things on market rates to create a nice, smooth picture for the buyer. Handle those items. Take steps with your key employees to keep them there and align your interest and theirs. And if you can do those things and allocate the part of your job to others that you don't like while getting your personal house in order, you're going to be in good shape. Because we have lots of business owners that don't ever sell their companies because they took the steps to build the internal team, that they don't have to do things they don't want to do. And they have the freedom they want. And they just as soon keep earning that 20% return on capital rather than selling. And that's usually the best scenario.
Yeah, yeah. Great advice. Great advice. Really appreciate everything you've offered up to the M&A Unplugged community. Dave, if people wanted to get in touch with you, how could they reach you?
So my email is dbuckley@kelleherbuckley.com, or our general phone number is 847-382-9130. Ask for Andy Kelleher or myself, and we'd be happy to talk to you.
All right, Dave, thank you so much. Really appreciate you being here.
Thank you very much, Domenic, for the opportunity.
So M&A Unplugged community, let me just recap a few items. Dave recapped some of these as well, but really worth pointing out, he made the analogy of staging your business much like you would stage your home when you're looking to sell it. It really, while being very different as far as the depth and breadth of what you need to do to stage a business, is so critically important. So you make sure that you're getting not only maximum value for your business, but you're keeping the maximum amount of dollars with the least amount of tax, and that you've really taken care of, your legacy and your family. Assemble the right advisory team and do it early. And when we say the right advisory team, people who really understand M&A transactions, succession planning, and all the things that go into that. Critically important in doing that is securing your executive team. Dave talked about a number of strategies to do that, with contracts that would, pay them some percentage or some amount upon a successful sale, and keep them motivated to stay there post transaction. It's good for you as an owner, but it's also good for the buyer. It will give buyers a lot of confidence that you've been thoughtful about running your business. You've taken care of your good people. You'll just attract more buyers as a result as well. And then the last thing that Dave brought up, I think is really key, is when you're doing this review and part of that staging, using a mock due diligence list as your template for what buyers are going to look at is a great way to really start with your staging. Go through that list and look at all of the items that might apply, and then start to address those items. Really some great information from Dave, and really appreciate him being here. And all the information in today's show is going to be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.